everybody, how you doing? This is Roberto Paredes, RP Home Group at Keller Williams Realty, and as usual, we're always trying to provide value, and we are on a Zoom call with our go-to lender, the one that we trust with all of our clients to provide the best possible service, the famous Marty Brooks.
Hey guys, glad to be here. Hey Roberto.
Hey buddy, hey buddy. So what I want to talk about today is there's a lot going on in general. And, you know, there's still people out there that need to either buy, sell, or refinance in real estate. So what we wanted to do is just, you know, provide you the facts. A lot of times people get anxiety of the unknown. And the way to battle that is to find out what the facts are. So Marty, based off of your experience and what you're seeing right now, how has this affected, let's say, loans in general?
Yeah, well, twofold as far as it's affecting guidelines, as far as some lenders changing guidelines, especially with government loans, which I'll get into a little more detail on. And then it's also just changing borrowers' ability to close, period, because some borrowers might be furloughed, depending on their job status. So you may have people that have gone into contract or in the loan process with a refi that now may not be able to close or may have to delay closing because they may not be working, they may have gotten laid off, they may be furloughed, they may have had reduced hours to take them out of qualifying. But so we've got different things going. We've got some qualification and guideline changes, and obviously we have a lot of people whose work status has changed. And
right. That
lenders are
so conventional, let's say, for example, so conventional loans, how are they being affected based off of what's going on now?
Conventional, as far as general guidelines, has not changed that much. Like every lender can set their own individual, what are called overlays. And overlay, well, going back real quick. So each general type of loan has its own set of guidelines, meaning conventional is set by Fannie Mae, Freddie Mac. FHA is set by HUD. VA is set by, as far as the general, there's a set of VA guidelines that lenders follow. But for each of those loans, each lender can add their own specific overlays to where a lender might have a different requirement added to the general base guidelines set by those entities.
Right.
So,
okay. So that's in order to, like, an extra layer of protection to mitigate risk. Okay, that makes sense.
Correct.
Okay, so
conventional has not changed that much. I mean, the minimum score for conventional is 620 still.
Okay.
From what I'm seeing, and we're a broker, so we have a bunch of different lenders that we use. So I definitely have a pretty good array to kind of see what different lenders are doing, plus what I'm seeing some of my other colleagues and lenders are doing that we don't necessarily work with. There might be a few different overlays added in, maybe for reserves, or if you're using a certain type of income to qualify for conventional, there may be an added layer, but for the most part, conventional has not been affected as much from a guideline standpoint. It's the government loans right now that are really getting clamped down on. So.
Okay. All right. So conventional hasn't been really affected too much, perhaps some guidelines as far as reserves or whatnot, but that would be more of a question case by case, depending on the lender or the brokerage that you're using. So let's talk about FHA loans. Now, FHA loans are government backed, and those are going to have more overlays now, correct?
Yeah. And the reason is, and kind of what's happening right now, and the reason I think a lot of this is going on is because of from a lending standpoint, banks and national lenders are about to be hitting a big crunch due to the forbearance that the government implemented, stating that banks have to right now provide offer forbearance options to buyers. So a lot of people are going to be taking that option and not paying loans back for a few months. Also, you're going to have a higher level of default right now because of people now becoming unemployed as well. So a lot of lenders are going to be hitting a crunch with having to be on the hook for making payments to their investors and servicers on behalf of the borrowers who are going to be in a forbearance period or maybe going into default right now. So they're anticipating that, and government loans are a little maybe risk. They have a higher default level than conventional because of generally they're a little looser in qualifying from certain standpoints. You might have more first-time home buyers. You have a lot of times a lower down payment. They will sometimes go a little higher in debt ratio in the past or lower score, have a little bit of credit bumps that conventional may have an issue with that you can qualify with on government loans. So they're going to have a higher default ratio. And right now, I think what's happening in the market is lenders are worried they're not going to be able to, they're going to have trouble selling them in the secondary market. So they're really cracking down right now. Okay. FHA being a type of government loan. And go ahead.
Oh, so with the FHA, then, because of the higher risk for the investors, they're just adding more layers of protection to lower the risk as much as possible. Now, you had mentioned something
Right.
that I want to go back to real quick, the forbearance. So that's something that's government mandated in order to assist people that have lost their jobs or their income is affected right now. Is there any, talk to me about any kind of specifics that you might know as far as, so is each lender have their own rules on how they're going to do it? And is this something, because I've been reading a little bit about it, is this something where they'll say, hey, don't worry about paying for 3 months, but then you owe that full amount, or they add that difference to your monthly payments moving forward?
Yeah, normally, right. Yeah. So, I mean, each lender might have, I mean, there's specific guidelines that the lenders have to follow as far as they have to offer, I believe, a certain amount of level of forbearance. But as far as what individual lenders may do, they may add different policy strategies and stuff added to that. But yes, if they go into forbearance, and let's say they take 3 months of not paying their loan, for most lenders, they're probably going to have to pay that all at once they start back in their payments, which is a large payment that can really put people behind. So they really need to know. And like I said, some of this will be lender specific, but they really need to get with their lender and find out if they're going into a forbearance program, they need to find out how that repayment is structured, because a forbearance is not a forgiveness. They are going to have to pay that back. So
Right.
whether or not they pay it all back at once, it's added in increments, meaning their payment goes up a certain amount each month to make up for that forbearance, or if it's possibly added onto the back end of the loan, they're going to have to pay that back.
So
That's
really,
something
that's
they're
the
going to
best
want
case
to.
scenario, though, right, Marty? Would you say? I mean, to me, it sounds like what you want to shoot for is that it's added to the tail end of the mortgage.
Right.
Correct.
I think that would probably be the best. Yeah, but it's really
All
going
right.
to depend on, they're going to have to talk to their lender or servicer about how they're going to make up the difference for them going on that forbearance. But yeah, something like that wouldn't really raise, it would extend maybe the mortgage. I mean, it just depends. Well, they're not changing the term of the mortgage, so it might raise the payment a little bit at some point. But that would be the best way probably to add it to the end of the mortgage, because it wouldn't really add a huge incremental, a huge change to their mortgage payment. If they're having to pay it all at once, then that's 3 payments all added. If they take a 3-month forbearance, that's
Right.
3 payments added on in that 4th month. If they're immediately going into where they're making up the difference over a staggered amount, it's still going to raise their payment probably by a significant amount as well. So
Yeah. So people do need to be careful. So it sounds like what they need to do is to call their lender and ask for their forbearance policy. What that looks like, and then get it in writing. Correct. And then
yeah,
see if it's a good fit for them.
right. Yeah, find out exactly about lender what their policy is going to be if they go into forbearance. Exactly. And then see, is that something that's going to be realistic? Because you might be putting on a Band-Aid for something right now that you may not be able to, you may not be able to repair. You may not be able to get take that Band-Aid off because you lose
Right.
your job for a few months. And then you have to pay a huge chunk of money. The whole reason you're doing this is because you can't afford to make your payment or to give you a little bit of relief. Well, even if you go back to work, you've lost money and lost income and still had to pay bills. So you're not likely not going to have enough money to make a huge chunk of payment in 4
Right.
months or whatever amount of
So true. So true. So, okay. So that's FHA then. So we talked about conventional, we talked about FHA, about the added, restrictions and guidelines there. Let's talk about VA loans. How are VA loans being affected with everything that's going on right now?
For the most part, there could be a few differences, but most lenders that I'm seeing make changes are kind of doing the same for FHA and VA, with maybe a few little differences. But if they're raising the score requirement, most of the time they're making it the same for both of them. If they're changing a debt ratio, where FHA and VA will only allow a larger debt ratio, a lot of lenders would have in the past gone off of whatever the automated underwriting system findings are. So if they have solid credit and they're approved in the system at conventional guidelines are normally capping debt ratios at 50%. So 50% debt to total gross income. FHA and VA, for the most part, if the automated underwriting system approves it based on FHA or VA guidelines, you can see debt ratios in the high 50s, for VA sometimes in the 60s. Most lenders right now are capping all of that. And it's pretty much what I'm seeing is the score of the debt ratio are kind of the same for both. They're both government loans, and it looks like they're kind of, you know, keeping those pretty much the same. So what I'm seeing right now, some lenders have not made changes yet as far as debt ratio and score. There are some that are still going low. Like FHA will allow, and this is a HUD FHA requirement. FHA will allow a score down to 580 with a 3.5% down payment, or down to 500 with a 10% down payment. Lenders set their score requirements right now. I do know of one lender, and there are probably some others out there, but one that we work with that is still going down to 580 on FHA. They already had a higher score requirement for VA. They were set at 620 for VA. So they have not changed their score requirement, and they have not changed their debt ratios. But 90% of the lenders that we work with have, and I'm seeing most other lenders out there across the boards, like either whether it's a colleague posting something or some, some message boards that I'm a member of with some different loan originators, it looks like most of them are doing this. So what we're seeing is the minimum score for most on these government loans right now are 640. But I have seen some lenders go to 660 and some as high as 680. The other thing I'm seeing is that debt ratios now on most of these are being capped at about 50%. Some others, internal stuff with certain lenders, like maybe 45% if you have a certain score or a certain, you lack reserves. There's other limitations, but at least 50% is pretty much the cap we're seeing for most of these lenders on government loans right now. So,
okay. So out of curiosity, if somebody were to get approved, let's say a month ago, and they're still looking for a property, and they find something, they're under contract, they could very possibly not qualify anymore because of these changes, correct?
Right. What they're going to want to do is reach out, if they're still looking, and they were pre-approved up to a certain amount, and they're looking at that max amount still. Obviously, they want to reach back out to the loan originator and go over everything with them to find out, has anything changed? But before they go into and if the loan originator is doing their due diligence, when that realtor, normally the real estate agent's going to reach out to them and say, hey, we're looking at a property, this amount, can you run numbers for me? Can you at that point, they're going to go in and do their due diligence, say, hey, we've got some changes. They were about here, but we're probably going to have to lower it down a little bit because their debt ratio now is going to be above where it would have been allowed in the past. If they were already at a high debt ratio, meaning They were a VA buyer, qualified at about a 56, 57% debt ratio. They were looking for a $300,000 house. The agent or the buyer reaches out to them and wants them to run numbers, and they're looking at, they're like, you know what, we're probably going to have to now lower expectations a little bit to stay under where you're going to be able to allow to go. So we might need to lower it to 250, just an example of something.
Gotcha. So it sounds to me like the best course of action for people that are actively looking is to make sure to reach out to their lender and see if anything's changed based off of when they made application.
Right.
So that's that. So we spoke about conventional, we spoke about FHA, and then VA. So let's talk real quick about refinancing. So what I'm thinking is that for those that qualify, it might be a good time to refinance. Would that be mistaken?
Yeah, it still is. I mean, for the most part, rates, the market is a little crazy because of all the unpredictability, but the rates are still low. I mean, a few weeks ago, before we really got into the extreme measures going on right now for like shelter in place and, people not really going anywhere, rates have been historically low, and then they went up a little bit due to like a refinance crunch, meaning most lenders had such an influx in refinance applications that rates bumped up. And I know we talked about this briefly on our last call. And then they went down a little bit more. The government, did some things as far as quantitative easing and stuff. Rates bumped down a little bit. Then they started kind of going up and down over the last couple of weeks. Now, I don't mean drastically necessarily, but they have been moving up and down, and there's really no method to the madness just because of the uncertainty in the market and what investors are scared. There's a lot of uncertainty, so you're seeing a lot of market movement. But rates are still very good. You're still in the threes on conventional. I hate throwing out rates specifically because they can change daily, but we can still do a refinance application for someone and get them in the mid threes right now as of today's rates.
All right.
So yes, it's still
right now. So right now, if you're higher than like a 4 and you purchased your home maybe over a year ago, then like now might be a good time to give you a call and say, hey, let's see what the numbers look like, right?
Right, to at least look at it. If it's been at least a year, You know, two main things. You want to be able to lower the rate and lower the payment enough to make sense. If they're not getting cash out, if they're just looking to strictly take advantage of the lower rates, make sure there's enough in that rate to make difference in their payment. You know, a better opportunity is going to be someone that's had their home for a few years. So their mortgage balance has had time to go down a little bit, and maybe they're in a position where that we can reduce that mortgage insurance. So if they've got 20% equity on a conventional, and we're doing a conventional refinance, they will not have mortgage insurance. So that will really bring savings. So you're going to lower the rate enough to lower the payment sum, and you're going to remove that mortgage insurance, which, you know, depending on the loan size, can be, you know.
Absolutely. Okay. So what, so that's good. That's good information. I think that a lot of people would be able to benefit from that. All right, Marty. I appreciate your time as usual. Hope you're staying safe, and that you are staying safe. And yeah, so guys, thank you for spending time with us, speaking to Marty Brooks. As usual, he has, you know, he's somebody I co-sign for with all my clients, and we usually work with him, and he does a great job. We trust him completely. So if you're interested in refinancing, please reach out to him, and we'll add his contact information. And if you're interested in speaking about, you know, FHA, conventional, or VA loans with him to see what it would look like, now is not a bad time just to kind of reach out. No commitment, just say, hey, you know, this is where we're at. We'll also add his link. He has a link that you can fill out your information, and that way it'll streamline that process. So it'll be a lot easier for you. Marty, take care of yourself, buddy. Thanks, everybody. Bye.
Thanks, Roberto. All right, buddy.